My name is Macrae Sykes, and I'm a portfolio manager with Gabelli Funds. As a firm, we host a number of conferences during the year where we get to hear from knowledgeable corporate officers and academics. So we are delighted to add another interview to our slate today. It's a pleasure to introduce Professor James Barth. He is a Lauder Eminent Scholar of Finance at the Harvard School of Business, which is a part of Auburn University. He is also a senior finance fellow at the Milken Institute. Most importantly, he's an accomplished author on all things financial services, including bank regulation and capital markets. Those writings include The Great Savings and Loan Debacle, The Reform of Federal Deposit Insurance, and Rethinking Bank Regulation, Till Angels Govern. Thank you, Professor, for being here today. I look forward to covering several topics of interest affecting financial services.
Thank you, Mac, for inviting me to be here today.
Great. So let's jump right in. We have a very exciting day ahead of us. Certainly, we look forward to the Fed announcement, and they certainly have a tough task as they navigate the markets going forward. I wanted to get a sense from you as to how you think the markets will react now that they've implemented QT and certainly a tighter Fed policy going forward. And how do you expect the Fed to be able to manage the risk of a bigger shock to the economy?
Sure, Mac. It turns out, first, what I'd like to say is that what's happening today with inflation is essentially due to inappropriate fiscal and monetary policies. I think in recent years, the federal government spent too much, drove up demand to too high a level. That led to higher prices. And the Federal Reserve printed too much money. That, too, contributed to inflation that we're experiencing today, an inflation rate that is at a 4-decade high. Now the Federal Reserve is trying to atone for its mistakes. It could have earlier raised interest rates, which it didn't do. That was a mistake. I think most people concede that that's the case today, even the Federal Reserve. So it turns out that today the Federal Reserve has a tough task, a task that itself created, because of what it's trying to do is raise interest rates enough to bring down the inflation rate. The inflation rate in May on a year-over-year basis was 8.6%. The Fed's target inflation rate is 2%. That's a big gap. And the Federal Reserve wants to raise interest rates sufficiently high to curb demand, bring down the growth in demand, to bring down the inflation rate. But if it moves too fast and too much, it may push the economy into a recession. That's a risk. As we know, real GDP growth in the first quarter was negative growth rate. We don't know, but it's likely to be a slow growth rate in the second quarter. So the Federal Reserve, though, if it doesn't raise rates sufficiently high, then inflation won't come down. And it isn't going to come quickly, regardless of what the Federal Reserve does. I think everybody's hoping that the Federal Reserve this time gets everything right, and we have what's called a soft landing, certainly not a hard landing, and certainly not a situation in which the unemployment rate were to go up and inflation would still be with us, because then we have what's called stagflation, increases in unemployment and still high inflation. So I think everybody's hoping for the best and that we can avoid a recession and still bring down the inflation rate.
So I think, as you alluded to, we had a historic combination of monetary and fiscal stimulus during the pandemic, and I think that was warranted at the time and believed, but it led to that outsized component of the balance sheet of the Fed. But it also had a tremendous impact to the bank deposits for the consumer, which rose significantly. And now today we have home equity at all-time highs as well. So the consumer on balance is feeling pretty good, especially with that balance sheet. And so as we think about the Fed tightening cycle this time around, the component of that consumer balance sheet, how do you think that is going to impact sort of the outlook for a hard or soft landing, and also as they project their monetary policy as well?
Sure, Matt. It turns out, we say that if indeed there's increase in home prices, that obviously benefits consumers that own homes. It turns out consumers, because of COVID-19, decided to engage in what I would call precautionary saving, put a lot of their funds into deposits. We had a surge in deposits at banks. That increased the wealth of consumers. So what we say, there's a wealth effect. Wealth goes up, and it did go up over the past couple of years. Went down slightly in the first quarter. So that wealth effect basically enables consumers to spend more than they'd otherwise spend. So that too contributes to an increase in demand. So the Federal Reserve has to take that into account when it raises interest rates. It wants basically to slow down the growth in demand. So it has to do a little bit more, given that if there's this positive wealth effect. But offsetting that positive wealth effect is obviously the decline in real wages of consumers. We've had wages go up. We've had prices, though, go up a lot faster than wages. So that's that income effect. Real incomes have gone down. That too can slow down the increase in demand. So the Federal Reserve really does have a tough task getting it just right. It's sort of the Goldilocks approach. Not too much, but not too little. Get it just right. And that's hard to do. We've had 12 recessions since 1945. And what we're hoping with this so-called soft landing is that the Federal Reserve does everything exactly right. Brings down the inflation rate. Again, it was 8.6% on a year-over-year basis in May. The target Federal Reserve inflation rate is 2%. That's a big gap. It has a lot to do, and it has to be careful it doesn't do too much too quickly with respect to interest rate increases. The other problem, of course, that's affecting wealth is the decline in stock prices. Again, there's been an increase in wealth, but now we're also seeing somewhat of a slowing down and consumers starting to reduce their savings, basically, given what's happening to their real incomes.
Very interesting. So you bring up the stock market, and you teach finance courses to the school there, and so we're interested in talking about bank stocks specifically. And if we think about the positives, higher rates, bigger balance sheets through loans and deposits, so those are positives for this environment. On the negative, there's a potential recession looming, which would come with higher credit costs and write-offs. So I guess in general, maybe you could just give us your sense of how you feel about the outlook for the banking community from a stock level over the next year, perhaps 2 years, in terms of kind of that investment universe.
Two things. One, typically higher interest rates benefit banks. They typically see an increase in the net interest margins. Loan rates go up relative to deposit rates, and that benefits banks. Banks have also benefited recently from a reverse in the loan loss reserves. That has contributed bank profits. So I see banks basically benefiting somewhat from higher interest rates. But as you point out, if the Federal Reserve pushes us into a recession, then banks obviously may suffer losses on the loans that they made and on other assets that they may be holding. So again, the banks are, I think, in a position in which they're not going to get into trouble like they did in 2007 and 2008. Banks didn't benefit, okay, because we had a housing boom and bust. That led to a subsequent recession, so-called Great Recession. And banks then, many banks were bailed out by the federal government. I don't think we're in that situation today. Why do I say that? We don't have a subprime mortgage crisis. We don't have banks involved in private securitization activities the way in which they were in the earlier period when we had the Great Recession and the housing boom and bust. So I think banks are much better capitalized today than they were at that particular point in time. So with all the capital that banks have, they can basically afford to be in a position, if there are loan losses, if the economy slows down, even if we go into recession, that they can weather those types of losses. So I think the outlook is pretty good for banks in the aggregate. One has to realize about 4 or 5 banks account for about half of all banking assets. Those banks are in good shape too. So I think they can weather any sort of storm resulting from the increase in interest rates. But it may be that net interest margins don't go up all that amount because right now with all the deposits that you mentioned earlier, on the balance sheets of banks, the loan to deposit ratio has actually declined recently. So banks are trying to be careful because they don't have to track any more deposits today. So as rates go up, I don't think you're seeing banks now raise the deposit rates to attract more deposits because they have a lot of extra deposits, too many relative to sort of loans that they might wish to make, giving a slowdown in economic activity and even the possibility of entering a recession.
Very interesting. So one of the things that we all focus on is technology disruption and how that affects the competitive landscape. And I would highlight that Apple and Goldman Sachs have teamed up for a successful fully digital platform over the last few years. And that it's been taking share and growing fairly significantly. Could you just talk about your thoughts on some of this disruption from the digital platforms, what it means in terms of competitive dynamics with the traditional banks? And then if we think about the digital being a virtual component, how does this impact or the competitive position of banks that are traditionally reliant on bricks and mortars and branches for client engagement and client acquisition?
Sure, that's an important issue, Matt, going forward. I think it's useful to point out that actually banks have been providing virtual banking services or home office, home banking services for quite a while. In 1981, there were 4 big banks in New York City that for the first time actually offered home banking services to their customers. So we go way back in time when we think about banks offering online banking services to their customers. We even have several banks now that are internet-only banks, like Ally Bank. We had another bank even earlier in time that started up and then subsequently closed called NetBank. That was an internet-only bank until close to the end of its existence when it actually opened up an office. So it turns out banks have been involved in internet banking, online and home banking, I think for a long time. I think almost all banks now offer some online and home and mobile banking services, which I think is good. And a lot of banks, as you point out, have indeed engaged in partnerships with fintech companies or big tech companies. But there is more competition for banks. And banks have, I think, in recent years, decreased the number of their branches because it's fairly costly to have an extensive branch network. And I think even COVID-19 provided information to banks that told them that they can do provide a lot of banking services without having a lot of branches. They can have drive-through windows, smaller offices, provide banking services. So I think we see the number of banks has gone way down to fewer than 5,000 today. It turns out the number of branches in recent years have also started to decline. I think banks have found now, especially for younger people, that online and mobile banking services are what they really want. But don't forget, a lot of the older people who account for most of the wealth and the profits of banks may not be as comfortable not having access to a bank office in which they do their business. Indeed, one of my colleagues here in the finance department told me a few days ago that they had an account with Ally Bank, but it turns out his wife said she also wanted an account at a bank where she'd go inside and see people and not do everything online with her iPhone. So it's interesting that here he preferred simply online banking, but his wife thought she felt more comfortable going into an actual banking office, seeing a physical presence for the bank, and having access to individuals she could talk to rather than a chat box or something. So I think younger people, as wealth is distributed from older people to younger people, will feel much more comfortable with online and mobile banking. But we still have a lot of older people, perhaps myself included, that don't mind going into a bank. Indeed, sometimes you go into a bank and you'll see people, or you used to see people, and you still do now that they're opening up their lobbies again, older people, because they have a lot of wealth, they've retired and have a lot of time on their hands, so they'll go in and talk to people within the bank. So it's a place to go and talk to people, have that connection with younger people don't really care all that much about But I think banks are adapting and they're getting more competition from fintech companies and big tech companies that now are offering services, not all the services that a full service bank offers, but offer different type of services, loans, payment services, those sorts of things. So there's more competition, but banks are adapting, and I think they're here to stay. But branches are probably going to decline over time. The other point of this, of course, in lower income communities, where there are also a lot of minorities, sometimes they don't have access, good internet access. And banks have to be careful that they don't close too many branches that are in low income and minority communities, and find those are the very people that don't engage much in online or mobile banking. So I think that's an issue too that the regulators may be paying attention to.
I think you bring up some great points about the generational component, the engagement, and my mother-in-law is another person that likes to go every Saturday. I'm not so sure she
You don't
even
want
has
to
a bank
displease
card.
your mother-in-law, do you, by saying too many things?
Yeah, no, I've learned that before. So it's been years to try to get her a debit card and so on, but that's great. So obviously you're an expert on bank regulation. You've written extensively about it. And we've seen a proliferation of these new firms, fintechs, non-traditional banks, I would call them, whether it's an upstart or a firm, and there are others out there. It's been a growing piece of the market. And then we know that buy now, pay later has also gained more acceptance as well, potentially disrupting the credit card companies. Maybe you could just talk a little bit about where you see that regulatory front going with respect to these non-traditional banks and some of the advantages there, and whether you think there actually needs to be more regulation on those institutions as well.
Yeah, I'm one of those individuals that's reluctant to call for more regulation. It turns out when banks have to comply, or even non-traditional financial service firms have to comply with more regulations, it means they hire more people who do nothing but try to satisfy the regulatory requirements, but they don't provide any services to the customers of banks. So if you add more people who don't engage in providing banking services, those people add to the expenses, but they don't add to the revenue. So expenses go up rather than revenue, and that hurts banks. So we have to be careful we don't over-regulate banks. So some of these firms like Affirm, buy now, pay later, what they're doing, I think, is providing a potentially valuable service. They connect basically merchants to customers. They get a return for doing that, connecting the customer banks. The customer gets the product and pays for the product later. And these types of new firms say there are going to be no charges basically associated with those transactions, no late fees, those sorts of things. And in some cases, no interest is going to be charged for some customers. So the firms do their own underwriting and they evaluate each and every transaction as it occurs and decide whether or not there'll be an interest rate, whether or not there won't be, or whether or not the customer will be able to buy now and pay later. That's an innovation, and I'm not opposed to it. I think what I would rather do, rather than over-regulate those types of firms, is wait and see if indeed those firms turn out to provide a valuable service without providing any undue complexities or unfairly treat their customers. We do see recently that a firm like Affirm, its stock prices declined much more rapidly than, say, a credit card company like Visa. So it's not clear yet exactly how they're going to perform over time. So I think one doesn't have to rush to try to over-regulate them. We know the Consumer Finance Protection Bureau is there looking after, presumably, customers of banks and other financial institutions to make sure nothing inappropriately is being done that would harm consumers. So again, one that shouldn't over-regulate, I think, financial institutions when they offer a new product. I once heard there was a member of Congress who had a mortgage loan, and he got it from a state chartered institution. And it turns out he was notified that his mortgage payments are going up. Why? Because he had an adjustable rate mortgage. And he became unhappy and said, this is harmful. How can these banks basically raise the interest rates on their mortgages, people won't be able to afford the mortgage and will default on their mortgages and lose their homes. So there was a moratorium, I understand, that was imposed. And it turns out ultimately decided that wasn't a good idea, that there's nothing wrong necessarily with giving a consumer a choice, an adjustable rate mortgage or a fixed rate mortgage. And that's what we have today, a choice. The risk can be borne more by the lender, or it can be shifted to the borrower. And you give people a choice. And it turns out that's a product that now exists along with a fixed rate mortgage. That is the adjustable rate mortgage.
Great. Well, thank you for sharing those thoughts. It's quite interesting. Okay, sticking with regulation and as well as one of the topics du jour, cryptocurrency. I wanted to just pick your brain a little bit about, again, there's a market that's largely unregulated. I think part of that is just trying to figure out what the actual market is and those assets are the description of them. But maybe you could just give us your insight too on, whether you think that regulators need to be more active in trying to provide more oversight of this unique class of assets. And then also, as we look at some of the declines in prices today, some of the disruption, obviously there's some dynamics there. Maybe just get your sense as an expert kind of in the space of how you see the overall digital assets universe maturing over the next decade or so.
Well, as we know right now, talking about cryptocurrencies or cryptocurrency assets is a dicey proposition. They're headed down, and one hopes the downward movement will stop and they'll turn around and once again generate value for individuals. But in my view, it turns out cryptocurrencies were always less regulated than obviously traditional banks, which are heavily regulated, among the most heavily regulated firms in our country today. I think a lot of cryptocurrency market participants would have liked some regulation. For example, to tell people whether or not cryptocurrencies are investments or are they commodities, exactly how they're going to be treated. So I think some of the cryptocurrency asset participants were sort of looking for some regulation, some guidance to provide more confidence that indeed the values were worth what people were paying for those types of assets. But the market obviously has indicated that cryptocurrency assets are not really a hedge against inflation. We've had inflation, and some people thought, the cryptocurrencies, Bitcoin, for example, would be an inflation hedge. Prices would go up, so would the value of cryptocurrency assets. That hasn't happened. Stock prices went down. It turned out cryptocurrency assets went down. So rather than being negatively correlated, that when stock prices go down, you'd see an increase in some of cryptocurrency assets. We find that the correlation was positive, I believe, more in the neighborhood of 60% or so. So they moved together. That's a concern, basically. What do we do about cryptocurrency assets? There are a couple members of Congress that have proposed regulation to regulate to a greater degree, but not very heavily, cryptocurrency assets. I don't think anything's going to happen this year with respect to Congress enacting legislation to deal with cryptocurrency assets. I think the good thing about cryptocurrency assets, they're relatively, they've been around no longer than a decade or so, but the value at last November was about $3 trillion. Now the value of cryptocurrency assets is less than $1 trillion. So I don't think, and this is good news, that the cryptocurrency situation is going to adversely affect the broader financial system of the United States, and certainly not the global financial system. Bank deposits today, you mentioned this earlier, but bank deposits today exceed $18 trillion at commercial banks. Cryptocurrency assets, I just said, less than $1 trillion. You start adding in stocks and bonds and other types of assets, cryptocurrency are a small percentage of all financial assets in the United States, and certainly a negligible portion of all financial assets worldwide. So I think the good news is that what's happening in cryptocurrency markets is not going to spill over adversely affect, for example, banks and other parts of the financial system. It also tells us there's an important lesson in finance that everybody has to realize. What is that lesson? We all know it, but sometimes we don't pay enough attention to it, or we forget it. We get too eager to concentrate our portfolio in relatively few assets. If one has a diversified portfolio, meaning a wide variety of assets, you mentioned some deposits, homes, or real estate, and stocks and bonds and cryptocurrencies, one's in a better position if one part of that financial system declines in value substantially. You don't want to put all one's eggs in one basket and find that they all get crushed. So again, one wants to diversify. Some people may not have diversified sufficiently, went too heavily into cryptocurrency assets, thinking they only move up in value. We know that isn't the case, but some people are still happy. I've had students tell me they bought Bitcoin when it was less than $10,000. Some people may say, I've had paper gains and I've had paper losses, but I'm still ahead of what I paid. The other thing one should learn, or perhaps is now learning, is if assets go up in value, now and then there's nothing wrong with taking some of those gains. And then basically, as they continue up, take more gains. And then if the price is reversed, it will go down. You still basically have gains to offset any of those losses, as long as the gains exceed the declines in prices. So some people only assume prices will go up, not down. So again, diversification and taking gains now and then when prices go up is a better way to protect oneself. And indeed, when we end up in a situation in which stock prices are declining, cryptocurrency prices, but again, even home prices are starting to decline. So again, diversification, take gains now and then. Don't try to go for the home run, make it big all in one quick move.
Well, that's great advice, Professor. Thank you so much. And thank you for sharing your insights today on a host of these topics. And wish you the best start to the summer. And thank you again for being here today. On behalf of Gabelli Funds, we appreciate your time.
Thank you so much for giving me this opportunity, and we all hope for the best. And over time, probably the best will materialize.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.